Hey, thanks for joining my channel for a few minutes today. I'm Eric Powers, a certified financial planner, and we'll talk for a few minutes about the stock market sizzle. This channel is dedicated to providing education and information to anyone willing to implement it. That mission sounds pretty straightforward, but there's undoubtedly something lost when using a lot of industry jargon. So in order to simplify that, I'll take quick side steps to explain a few things as we go. Let's dig in. Your portfolio of investments has likely performed nicely since the depths of the bear market, which was caused by the recession. So to clarify a few words I'm using here, a portfolio is simply a compilation of your individual investments. A bear market is when the market drops 20% or more, and a recession is an economic condition of lower productivity. While your portfolio has grown, and that's important on its own, it's where that growth has come from and where it will likely come from in the future that makes it important in relation to sector. So what's a sector and why is that important? We've talked about sector rotation on this channel before, and it appears that this sector rotation will be continuing. Rotation is nothing more than money flows between sectors. Broadly, we expect some further rotation out of technology growth sector towards the cyclical value sectors. Cyclical is a reference to business cycles with highs and lows of revenues. The Standard & Poor's 500 is a broad index of the market, which is composed of 11 business sectors or categories. Categories you've undoubtedly heard about, and some more recently than others, such as technology or financials or energy. Sectors are important in helping determine the allocation, meaning the distribution of funds within a portfolio. Because the economy is expanding so rapidly now due to the reopening from COVID, cyclically sensitive businesses that had the heaviest losses like restaurants, hotels, and airlines stand to gain the most. On top of that, the businesses that were also hit, including energy and financial stocks, should come back. The technology growth sector has contributed greatly to portfolio gains historically, disproportionately so that there's room for other cyclical value sector type stocks to outperform. So what about the economy, and why does that matter to a portfolio of investments? Without being political, there are forces that influence a company's decisions in order to be profitable, including fiscal policy and monetary policy. I'll quickly define fiscal policy as the government's ability to tax and spend. Taxes and government spending can become very political discussions very quickly, so we'll bypass it further from here and instead discuss a few points about monetary policy. Specifically, the Federal Reserve, more commonly referred to as the Fed, makes monetary policy. The Fed is our nation's central bank, and it is tasked with controlling conditions to manage inflation, unemployment, and interest rates. In terms of interest rates, it's been influencing rates to rock bottom rates by purchasing bonds from the Treasury, and it's been doing so at a rate of more than 100 billion with a B per month, which consequently pushes money out into the economy. The result of the easy money policy can be inflationary. A simple way to express inflation is when more dollars are chasing fewer goods. Even though there's a lot of money being pushed out, the Fed believes that the inflation we're experiencing now is transitory. In fact, the Fed has been trying to jumpstart inflation for 30 years, and it's counting on increasing inflation as part of the plan. Short story long, there's also an expression in favor of owning stocks over bonds currently, which is don't fight the Fed. The Fed is very careful about its language, so as not to surprise the markets. Analysts who pay close attention to the language try to interpret the timing and the significance of policy changes, including what we're hearing more about lately, which is tapering. Remember, the Fed is buying bonds, and the talk is about tapering the purchasing program as we approach the end of the year or early next year. Sometime after the Fed stops buying bonds, probably a year or so, it'll work to then move interest rates upward. Let's pull all this together with a reference to steak. If you're looking forward to grilling this summer like I am, Think about the market like a sizzling steak. After taking it off the grill, it's best to give it a minute to rest before taking that first juicy bite. Steak. Point is, the market has been sizzling, and although a pullback is likely before the end of the year, we don't anticipate a fizzle. Keep an eye on your allocation as you consider various factors like we've discussed today. I hope you found our time together helpful. And if you're interested to hear more from me, subscribe to the channel or ask to be added to my e-newsletter. Bye for now.